morning, Doc. Nice to see you again. We're back on air.
Yes, g'day Lou. The old team's back, and I don't mean old in the ageing sense. I just mean the past team.
Yes.
But it's good to be back. And of course, Lou, it is the first week in June. So I guess we've sort of hit the midpoint of the year now. We've still got a month to go before we've passed the halfway mark. But we are, I guess, traditionally in the midpoint of the season. Certainly the end of the autumn selling season is now upon us. Even though autumn's finished and winter has started, the autumn selling season notionally goes till the end of June. And, of course, then we get in most eastern seaboard markets, we get the winter selling season. And, of course, that's typically the quieter part of the year. Because it's not because people are on holidays or it's cold, it's because we get school holidays. Well, so it is about holidays to some degree. But it's because we then get that, a lot of the energy from the first part of the year has dissipated. And, of course, that energy through the autumn selling season really does reflect buyers and sellers over the Christmas break period and into the new year, thinking about, do we get the new house? Do we move on? So all their decisions are sort of made in that holiday period, and then they're activated in February, and then the buyers have to buy, and then they have to sell, and the sellers sell, and then they have to buy. And that brings us all the way up to the end of June.
Yes.
And, of course, we have the holiday interruptions through April. So that's what drives the autumn selling season. And, of course, then we get the mid-year break, school holidays. A lot of that activity is gone in the first half of the year. And then people start thinking about, hey, let's get that property before the end of the year. Let's sell the house before the end of the year. And, of course, that's where the spring selling season is generated. And so July and August are the months, particularly July, where that decision-making is made, and then it's activated at the beginning of September, more or less. And just like we have with the autumn selling season, it works its way all the way through to the end of the year, with buyers buying and then having to sell, and sellers selling and then having to buy. But so now we're right at the end of the first part of the two selling seasons that we have annually, the autumn and the spring. So we're in a really good position, and we've known for a while now to be able to understand what's happening in our markets. And it has been a tremendous ride for the first half of the year, particularly in Sydney and Melbourne. And I think what's interesting, Lou, is that we're starting to see a bounce back in Brisbane and Adelaide. They're now coming back, second wind after having a pause at the beginning of this year. Of course, they were the markets that were the strongest last year when Sydney and Melbourne were weak. Sydney and Melbourne started to rebound, and now Adelaide and Brisbane are following suit. So it is about the timing of the markets. Not all markets work together at the same time, but they do tend to follow each other. And that, of course, reflects what's happening in the economy. And, of course, we know that fundamentally means what's happening with interest rates. And that's our number one story today, Lou, is the interest rate decision that was made this week by the Reserve Bank for June. And I think it was quite interesting, the decision by the bank to increase rates. But I've done a bit of a long-winded intro there, Lou. I don't want to spoil all the gear.
I thought it was going to be a very simple, new month, new rate.
Yeah, well, I guess you're right. And we shouldn't be surprised. But, God, with the Reserve Bank, I think we always should. We're always waiting to be surprised. But I did think that it was a bit of a line ball decision, but I think I was wrong. So I guess shall we start the pointy part of it all, Lou? And
yes, sir. Let's get started.
And what's happened this week in property? Property, there's a good byline, a good tag. So my housing market, of course, we're always active during the week, and we work together with Infinity to bring all our viewers the latest information, hot off the press, literally hot off the press, in regard to what's happening in housing markets. And as we always say, Lou, we're about the current state and future prospects, particularly the current state. We like to be able to understand our housing markets in as close to real time as we possibly can get. And that's important because a lot of the data that does come through from other sources tends to be a little backward looking, but not at My Housing Market at Infinity, where we're all about telling our stakeholders about the here and now. And of course, it's been a tremendous period this year for a revival in housing markets, but it has come despite the bogey of higher interest rates, Lou.
Yeah.
And that bogey, if it has been a bogey, I don't know really. Is the market and the economy just saying, ho hum, another interest rate increase? Did you hear about the interest rate increase? Oh yeah, whatever. It's sort of a bit like that.
Bit of old news for some people, thinking it's already happened. Well, let's move on.
Yeah, and it's I guess the more you have and the less, sort of damage it does, as it's always predicted, the more you think, well, who cares? Another interest rate rise. Well, of course, it is important because it does mean that you will be paying more for your mortgage. And that's not good news. Nobody wants to be paying more for their mortgage. But the offsets to that are you're actually getting more for your house now or your unit because prices are rising. So your wealth is increasing. And your wages are still rising at the fastest rate in over 10 years. So the offset to those higher rates is higher income and higher asset values. But yes, the Reserve Bank yesterday, Lou, on Tuesday, decided for another rate increase. Probably not a surprise overall. I mean, I thought they would increase, but I did think it was going to be a close decision, Lou. I didn't think it was sort of a no-brainer. I thought the May decision, which followed that pause in April, which was a bit of a shocker to me. I couldn't believe they paused rates in April.
Yeah.
But I thought they had to bring them up again in May because the data was still very strong. But it's been interesting that, over the last month, Lou, we've actually had some signs that the economy just might be feeling the pinch from those higher rates. We've had 12 interest rate increases, Lou, since May last year. That's a lot.
Yeah.
This is a record trajectory of interest rate increases. 12, in basically 14 months. And we had the compulsory break for January, which they don't meet over January. And we only had 1 month where they didn't pause, and that was April. And that was a bit of a shock. And maybe they're catching up with what they missed out on that opportunity to keep rates rising in April. But we did have some signs, Lou, which I thought might have made the decision a little bit more line ball this month, because they keep telling us it's all about the data as it comes through. And we had, of course, the main data points that we look at in terms of particularly the economy overall is the jobless rate, the employment market.
Yep.
Yeah, and that was a little soft over April, which is the latest data. We actually saw the unemployment rate increase to 3.7%, which, hey, let's be clear, is a very, very low number. Hey, there's no problems with 3.7% unemployment rate, let me tell you. It's
definitely not.
Well, it's still tracking at, the lowest since the early 1970s, and that was a completely different ballgame back then. So it's the lowest, near the lowest on record since we've been taking the monthly surveys. The 3.5% of the previous month is the lowest on record. So let's not get too excited about what is still a tremendous, unemployment rate reflecting a very, very strong jobs market. But it wasn't just the unemployment rate that ticked up, Lou. We also saw the number of jobs falling. That was down, and that followed 2 months of very strong jobs growth. So perhaps there was some adjustment going on there. But not only did we see job numbers falling, we actually also saw the number of those unemployed increased. And that also followed 2 months of falling numbers of unemployed. Higher unemployment rate, fewer jobs, more unemployed. And we also had the participation rate falling over April. So, and the participation rate, of course, it measures the proportion of those in the workforce from the population. So it meant that we had a lower proportion of those from our population in the workforce. So, which basically means people left the workforce. So those are the main indicators or the main measures for our employment market, Lou, and they're all negative over the month. So, that's the first real sign that interest rate increases are just starting to take the supercharged energy out of our employment market and our economy. Now, again, let's be very clear. This is still a really, really strong economy, but it's got to start somewhere, Lou, the signs of easing. So I thought that those that were, inclined to want to have higher interest rates, they might have taken that. Well, certainly an argument in the favour of higher rates. Of a rate pause. I'm getting mixed up here. Those that were saying, okay, well, this is the time maybe when we wait and see and have a pause because it looks like the economy's being impacted. Well, there's an argument in favour of that. But that's just the unemployment data. But the other driver of consumer activity or measure of consumer activity is retail sales, Lou. Yeah. So we had retail sales data that came out for April. Now, that was also flat. In fact, it was the flattest result the first flat result we've had since the COVID lockdown period. So the trend of retail sales is certainly now falling over recent months. And as I said, that it was a flat result, which was, again, another indication that perhaps that higher interest rates are starting to work in terms of reducing demand. And that, of course, is the big plan from the RBA. So, a weaker unemployment market or a weaker jobs market and weaker retail sales data. Now, again, like with the unemployment data, Lou, the retail sales are still massively higher where they were prior to COVID. Still very, very, very strong numbers. And still higher than where they were a year ago as well. So, it's still a strong economy, but there's two sort of signs there that, higher interest rates are starting to work as they're supposed to work, which is to reduce demand. However, but again, this is a one-off measure. It's 1 month. And what we need to see, I guess the Reserve Bank needs to see to confirm that these higher rates are starting to reduce demand is a couple of months. We need to see this trend consolidate. We need to see that, it's not just a one-off that's occurring, right? We need to see this consolidating. Now, I just want to mention something, Lou, that we also, which we'll look at today, we also had home loan data out for April this week or the end of last week. And it was a bit of a surprise on the negative side. We actually saw home lending fall after 3 months of increasing. Now, we'll talk about that in some detail shortly. But part of the analysis for that is that I'm just starting to, I think we have to start to ask questions about the seasonal adjustment models that the ABS is using. Now, this is important because we've had basically a really negative April, retail sales, home loans, and the labour market. Now, April is a holiday month. We know that. So it's a bit of a distracted environment. But the ABS has stated that it has had problems with its seasonal adjustment measures because of COVID, because it was all, put out of sync because of COVID lockdowns. It changed everything. And of course, seasonal adjustment is all about measuring what's happened in the past to understand which months are better and which months are worse. So you make an adjustment for the better months downwards and you make an adjustment for the worst months upwards, you understand? Now, the ABS has said, look, this is really difficult now because we've had, all these issues with COVID changing, over a couple of years, changing what happens typically in a month because, it was locked down. So they've said, look, until recently, they've said, look, we can't really take a lot of notice of the seasonal adjustment model. So they've said just use the trend, which just looks at the trend over recent months, not the seasonal adjustment. Now, I reckon, Lou, maybe that they still haven't got the seasonal adjustment thing working properly. Now, maybe not. But it's just a bit of a coincidence that we've had all these measures, these seasonally adjustment measures, all negative over April. Now, I wouldn't be surprised if we saw a bounce back over May. So, again, this sort of adds to the sense that this might have just been a one-off, what's happened over April. It might be due to some of the measurement issues that the ABS have, Lou. And that, we might see a bounce back when we get the May data coming out, which begins with the unemployment data next week, at the end of next week. So let's just take this all with a grain of salt, Lou. But certainly, if it is as it is, and we do get follow-up weakening in our labour market and retail sales and home lending, although that's more about the housing market, of course, then, maybe this is the first sign that these, 12 interest rate increases in 13 months are starting to work. They've got to work eventually, Lou, right? Because they're going to just keep pushing them up. But I do think, obviously, that if it does continue, then the RBA will pause rates again. But let's now look in a bit more depth with what the RBA said yesterday or said on Tuesday in regard to its decision. It said quite clearly again, and this is a little bit of a shifting narrative, I think, that we're getting from the Reserve Bank. Obviously that April pause was what? You're pausing? Despite, what was still strong data. And they were ignoring what was still, pretty ordinary results from, the inflation models. But now they've basically said that that they're really focusing on inflation, which of course they always have had. But they have said that they're looking at the jobs data and retail sales and these sort of things as well as another indication. But now they're saying really, hey, forget all that. It's all about inflation. And this just gives a sense that it's one thing one month, it's another thing that month, that, they seem to have shifted to a much harder line stance in terms of controlling inflation. Because as I said, why did they pause in April? Because inflation really, hasn't improved. And that's what they're saying now. But we can see there the trend. Look at that. This is our interest rate model, Lou. And you can see have you ever seen a steeper slope than that? It's
a climb, isn't it?
It's whoosh, mate. It's it's like a rocket way up there. And we're now the official rates at 4.1. But we're still, and I think this is part of the story that people perhaps don't understand and financial journalists don't understand and those that make predictions perhaps don't understand. We're still, the best part of 1% lower than where we were when we peaked back in 2011-12, Lou. So, historically, these rates are still very low, when we compare them with previous raising cycles and where they peaked. And we've got to remember also, we started at zero, you know what I mean? We started at 0 or 0.1%, which is basically zero. Yeah. So, okay. No wonder it's been a heavy-duty rebound, but we're still not back to where we were in 2011-12. We're still the best part of 1% below that. So maybe that's part of the reason why, particularly our housing markets have rebounded and why our economy is still very, very strong. But when we look at the comments that the Reserve Bank made in its announcement for a higher rate, I'll just read you what they said. Well, this is what the governor said, Lou. It said inflation has passed its peak. Yeah, well, that's good. But at 7%, it's still too high. and it will be some time before it's back in the target range. So clearly saying inflation's too high. And then it says this further increase in interest rates, that decision that was made for June, is to provide greater confidence that inflation will return to target within a reasonable time frame. So they're just saying, like, forget everything else. Inflation is still too high. It's still going to take too long to get it back to the target range, which it's 7% now. They want to have it at 6.3%. 2 to 3%, 6.3, 2 to 3%. And they reckon, they've got to keep acting to get it there within a timely time frame. So recent data, and this is reiterating that, is that they say recent data indicated that the upside risks to inflation have increased. So they're saying it actually looks like it's getting worse in terms of the risk outlook for inflation. And this is what we've discussed a number of times here, Lou. And it said that while goods inflation is slowing, and that was always going to happen once we work through the COVID lockdown process. You don't have to wait 2 years to get a couch anymore or a car, because that's all now. Now, that would have happened without interest rate changes. Let me tell you, that's got nothing to do with interest rate increases.
No.
That was just the roadblocks from supply that happened through COVID. And, of course, all that demand that was created by the stimulus packages. But the issue isn't the goods prices, it's services prices. So that's, just everything basically. It's not just goods, like couches and cars. It's things like your cup of coffee and, all those bits and pieces, services that you purchase that, not so much a cup of coffee, but, items, not items, but things that sort of, or services that you are engaged with is still high and rising. And what they're saying is that that's the case overseas, that services costs are rising, and that it's proving to be very hard to shift, overseas. So that's something that we can expect. And it's also mentioned that labour costs are rising. So that's wages are rising briskly. And that's not good, because productivity, and that means the return that businesses are getting on higher wages it remains subdued. And that's because, the employers are having to pay the higher wages, but the only way they can cover that is not through increased productivity, that you're working harder. They have to cover it by putting up their prices. And that's the problem. Higher wages. The employer says, okay, I'll give you a higher wage because I've got to, because I'll lose you if I don't do that, because there's so much work around. The only way I can cover these big wage increases is to put up my prices. In other words, if that's their offset to doing that, not that the worker is producing, at that level of those wage increases to offset the cost to the employer, if you understand where I'm getting at. And this is the issue that obviously the Reserve Bank is now focusing on. It's saying this is a problem overseas, that wages are rising, that they're being passed on to higher prices rather than improved worker productivity. And this is a change. This is, to me, they've gone from being, I thought, a little bit of a bias towards being careful with their rate increases because they're worried about creating a downturn, and that's why they paused in April. But they look like they've changed, Lou, that they've changed their outlook, and now they're saying, no, we've got to keep going here. We're worried now, whereas maybe, they were prepared to wait and see. I think that they're going to need a couple more months, to really, see that the economy is declining. But then, they're really going to need to see that inflation is starting to improve. So, I think, unfortunately for mortgage holders, it does mean more rate rises coming through. Now, the other thing that maybe concerns me a little bit, I know we're talking a lot about the Reserve Bank today, Lou, that does concern me, is that the Reserve Bank again mentioned house prices are rising. They've been sort of dancing around that because they were one of the many who predicted a house price crash this year, and they got it wrong, as many others have. and we're really getting housing markets building up ahead of steam, Lou. They really are, particularly that Sydney market, which I think now might get 10% this year. Can you believe it? Not 10% down, Lou, 10% up. It's already halfway there to May, right? So
Agreed.
I think the Reserve Bank may be, Lou, also being influenced because they've had a really strong focus on the housing market, which I don't agree with. The housing market isn't the main game here, and I think it just tags along with what's happening with rates and the economy. It shouldn't be used as a measure of, what the Reserve Bank is trying to do, in my opinion. But I think maybe the Reserve Bank, having got it wrong, and they have got it wrong on the housing market now for quite some time through the cycles, I think they're a little worried if they pause that it might, accelerate what's happening in the housing market. Even though we're seeing strong growth this year, prices are still lower than a year ago, Lou.
Yes.
That's why we're seeing buyers in the market. They're thinking, hey, this is great. I'm buying something now. And prices are still lower than where they are a year ago, which, of course, helps to offset the higher interest rates, doesn't it?
Yeah, exactly.
And their wages are rising at the fastest rate in over a decade. So I think perhaps that's another reason why the Reserve Bank has hardened its stance, I believe, in terms of its outlook for interest rates, despite some easing in economic activity, is also because, they have this almost obsessional focus on the housing market. They're part of this, maybe this, sort of bubble fantasy world, which continues to be proven, quite ridiculous in terms of house prices in the housing market. So, unfortunately, we're probably going to have to look forward to more interest rate increases. But I do think if we do see an emerging trend in terms of the economy that we saw, that weakening over April, shouldn't really call it a weakening, but, it was a weakening. But I think we might see a bounce back in the May data when it comes through, and a bit of that might come from these issues with the seasonal adjustment measure from the ABS. So let's wait and see. It's very exciting, isn't it? So stay tuned. Of course, when we do look at April inflation, and that's the data we did have out recently as well, and this is the monthly data that they've introduced, Lou, for inflation. The ABS now does a monthly data. And I think the Reserve Bank's now looking at that a little bit more carefully. And it wrote the annual inflation rate, headline rate, was up to 6.8%. And I think that's what's concerned them. And it was basically that's the annual growth in prices, up from 6.2 to 6.8 over the month. That's the monthly inflation versus the same month last year. Higher fuel costs were the primary contributor to that rise, and there's some shifting because of the change to the support mechanisms the government have been providing for fuel tariffs, etc. Not some good news on fuel, just as an offset to that, is that it looks like OPEC, who are the oil producers, are really going to start to tighten up their supply, which unfortunately might only mean higher fuel costs down the track, which, of course, is not a good thing for inflation. But when we look at underlying inflation, Lou, which takes out things like food and petrol, those volatile items, it actually fell down to 6.5%. So it was a bit good news, bad news. Headline inflation up, because of fuel basically. But the underlying inflation, which takes fuel out of it, and food actually fell. And interestingly, the most significant contributors were housing, fuel and recreation to overall inflation. And housing, of course, continues to rise, even though building costs are starting to ease finally. And we'll look at building costs next week, Lou. Rents are rising strongly, continuing to rise. And we'll actually look at the rent report for May next week as well, and recreation. So that's the latest info on inflation. And this is, where the Reserve Bank is focusing. And as you can see, this data tends to also jump around a little bit from month to month. So I hope they're not sort of relying on this as their monthly decision-making focus, because it can be up and down and change, as we saw with that April number. But we'll see when we get the May number which will be coming out in a couple of weeks' time. So interest rates up, Lou. Probably no surprise. I thought it might have been a closer decision than actually the commentary is telling us. The Reserve Bank has said it is really worried about inflation, particularly services inflation, that we can expect more interest rate increases down the track. And we await the next set of data that comes out before the meeting for the July decision, Lou. So I also mentioned we had the home loan data come out. And again, this was a little bit interesting, Lou, in the sense that home loans actually fell. And that fall in the April home loan data followed 3 consecutive months of increases, which typically reflects what's happening in the housing market. We typically see in a revival mode, as we're seeing in our housing markets, also we see more housing loans coming through, which makes sense, obviously, because there's more buying activity happening. But seasonally adjusted loans were down by 2.9% over April, and that followed a 6.2% surge over March. Now, this is getting back to what I'm saying, Luke. We had this massive increase in home loans over March, and then we've had a fall over April. Now, this is seasonally adjusted stuff, so it's supposed to sort of account for this volatility, but it's not. So, maybe it was the holiday month, maybe less activity, but that holiday pause or distraction should be accounted for in the seasonal adjustment model. So we shouldn't be blaming it on holidays, because that should be offset by the seasonal adjustment model. So again, I'm just saying we need to be a little careful with this data, because we might, as with the labour market, we might see a bounce back when we get the May home lending data. So like I said, we need to just take this a little bit with a grain of salt and, reflect on perhaps some issues with the seasonal adjustment model, because it's come out of the blue, this, just really as the unemployment and the retail sales data came out of the blue a bit. But, we've got to take it at face value going forward. So owner-occupier lending was down 3.9%, so it led charge downwards. Investor lending down just 1.5%, so in a negative way, it was the best performer. And first home buyers, which were very strong the previous month, were down by 2.1%. And like I said, I think there's plenty of motivation out there for first home buyers. I'm a bit surprised to see those numbers falling, Lou, given, surging rents and prices rising and all those government incentives, new ones in New South Wales announced. You would have thought that home lending for first home buyers would be higher. So, let's wait till next month and see if we're on the money regarding these issues of measurement from the ABS. So there's the trend. You can see there that obviously it fell last year with housing markets backing off through that adjustment process with higher rates and obviously a lot of negative sentiment. And then we've seen it bounce back early this year and then just falling away over April. If we do pick up again over May, it will really stand out, Lou, as being an outlier. But, let's wait and see going forward. You can see there that all owner-occupiers, first home buyers and investors, as we said, all fell over the month. Again, a little bit of cause for suspicion, particularly in regard to first home buyers, who you would have thought would be going gangbusters given all the motivation they have to get into the market. And you can see there that even though, the month we were all down, we mentioned that, but over the past year, when we compare this year to date versus the same period last year, and when we compare the full year ending April 2023 versus the year ending April 2022, we're down a long way compared to the year, compared with those measures. You've got to understand that there's a little bit of a bias here that makes it look worse than perhaps it is, because this is measuring the value of loans. And, of course, we know the value of housing fell last year. So obviously that means that the value of loans fell because properties aren't worth as much. So there was around about a 10% bias on the downside because of lower property prices. So we need to sort of account for that a little bit. But nonetheless, certainly the market is not as strong as where it was a year ago for home lending. But we know that's the same case with home prices as well going forward. So and when we look at the capital city performances, the state performances, South Australia was the top performer, but Queensland continues of the major states, if I can call them that, New South Wales, Victoria and Queensland, to be the best performer, not just over the month, but over the year as well. And I think, again, a little bit because their prices have held up a bit more perhaps, so the home lending looks better, but also we're starting to see a bit of a bounce back in that, particularly that Brisbane housing market, which has come a bit sooner than many expected, given that it was still booming a year ago, or in fact, it was still booming 6 months ago, the Brisbane market and the Adelaide market. So now, is this the big news? I don't know.
This is it. I've been waiting for this.
We've been waiting for this. Well, I'm sorry to keep you waiting. But when I'm on a roll, I'm on a roll. We've really gone deep into the economy today, but I think that's important. So every weekend, of course, we monitor the auction results. And the reason we do it gets back to what I started saying, Lou, and that is that it's important for us to have a real-time insight into what's happening in the housing market. And weekend auction clearance rates give us a real-time insight to what's happening in our housing markets generally, particularly, obviously, the big auction markets, and that is Melbourne, Sydney, Brisbane, Canberra and Adelaide. The other capitals don't really have an auction market at all. So those 5 capital cities that have a reasonably strong auction culture, the results from those weekend auctions give us a clear insight into what's happening broadly in the market. And we can see that when we track auction clearance rates here in Sydney with Sydney house prices. You can see that they track each other quite closely, and it's the same story in Melbourne. Higher clearance rates, higher prices, and lower clearance rates, lower prices. And it's also the level of clearance rates when we do get an easing in the market that tell us just how significant this easing is, because we really didn't get below 60% in Melbourne and Sydney last year, Lou, during the depth of the market. And that was well ahead of the depth of the market way back in 2018 when we had similar issues with confidence affecting the market. In fact, the market fell under 50%. In fact, it got nearly to 40% clearance rates in Melbourne and Sydney way back in 2018, which is where we had a more significant decline in prices. But here we troughed out at around about 60%. It showed us that once those clearance rates started rising through September last year, that the market was on its way back. And of course, that's clearly been proven. So drum roll, everybody. This is last Saturday's result, the first weekend in June. So we've greeted winter, not the winter selling season yet, Lou. I explained all that. I've done a lot of talking today, Lou. Voice is holding up, so I'm pretty happy. But drum roll, Sydney, bang, 82.3%. Whoa. And, of course, we've been predicting this. And, of course, Graeme has predicted this for some weeks now. And finally, we've been knocking on the door, and we've been knocking on the door really hard, Lou. And here we go. So the previous weekend in Sydney was 79.8%. You really don't get much closer than that. Now, 82.3%. Now, we can roll out the B word, which is boom. This is 80% clearance rate is what we use as a benchmark for boom conditions. It shows you that sellers generally have an 8 out of 10 chance of selling their property under the hammer of Saturday, and that's very strong. You never get 100% because vendors can be just as greedy as anybody else, and they're thinking, I'm not going to accept it. I don't care how high it is. We're going to negotiate because they just want more. But 80% is, accounting for the greed factor as well. We also had an extra 30 auctions in Sydney. Auction numbers are still reasonable. They're certainly not where they were a year ago, but that was the end of the boom a year ago. And a lot of sellers are in the market because they come late to the finish of the cycle. But certainly still a healthy number of properties on offer, and 80% blue. Now, that's the highest clearance rate Sydney's had since October 2021, which was the bounce from COVID lockdowns. 2020, that's getting on to 2-year high, Lou. So, hey, pretty cool. And as I said, up on the weekend before, and look how far ahead we are now of where we were a year ago, where we had our second interest rate increase a year ago. And, of course, the dogs were barking that this was the end of the world, that we were going to see a house price crash. Hello? Boy, if you're going to get it wrong, you might as well get it wrong savagely, because that's what happened. Because we're looking at 10% in Sydney this year, I think, which is a complete, universe different to what was predicted. So 60% a year ago. Melbourne, another good result for Melbourne. Let's not forget Melbourne, Lou. It's also knocking on the door. It had a big drop down in listings at the weekend in Melbourne, but still a strong clearance rate, just under 80%, 78.4%. Of course, listings are similar to Melbourne, similar to Sydney, well down on a year ago. But another good result there for Melbourne. And I think Melbourne's prime, perhaps not for 10% this year, but I think they're going to get between 5 and 10% this year, because they're still, I think got plenty of upside, that Melbourne market. Still good for buying value, I think, in Melbourne. And I think there's still some hangover from COVID yet to be fully relieved in the Melbourne housing market. Brisbane, another good result, a little bit less than the weekend before. Same amount of listings. The Brisbane, as we always discuss, tends to be a bit up and down, but 60% or nearly 70% plus is back to the strong results of a year ago in Brisbane, which was being fueled by all those interstaters coming in. And we've never seen clearance rates this high in Brisbane, because usually they're 50%, typically in a reasonable market. So to have them this much higher than 50, which is usually what they are, really shows, I think, that the Brisbane market is bouncing back. Adelaide, we're getting other signs of that, as we saw with our house price data last week. And Adelaide, as usual, 80% plus. It just keeps on keeping on. Very strong auction market in Adelaide. And Canberra, and this is another thing we've been suggesting for a month or more now, Graeme, is that the Canberra market looks like it is back up and running again. Now, it was the weakest of our auction markets. It was really struggling to get over 50%. It was 55, 58% there as markets were reviving. But it's really bounced back over the last month, and we're now starting to see some strong results coming out of Canberra. Now, we said that Canberra typically follows that Sydney market upwards. And that's what's occurring now. And of course, it's, and it came late to the party. It was, you can see from a year ago, it had nearly a 90% clearance rate. So Canberra, like Brisbane and Adelaide, was, its boom continued on when Melbourne and Sydney finished. So its adjustment process also came later. And just like Adelaide and Brisbane, it's reviving later than Sydney and Melbourne. But certainly reviving it is, Lou. And again, it reflects what we've been saying over the last month or so, given we've started to see those Canberra clearance rates ticking up. So if we look at the monthly results, the trend for Sydney, look at this, will you? It's just continued to – you can see how the market has revived since it bottomed out in terms of its lowest clearance rates in July, right? It's just really continued to rise, with December being the only real trend downwards. But we've been saying this all along, that as those clearance rates rose, it showed that the market was coming back. And eventually, of course, it's moved into positive territory with prices rising in Sydney. Same story in Melbourne, Lou, well ahead of a year ago. Again, you can see that trend rising. Brisbane flattened out, but we've seen a bounce back in that Brisbane market this year, as we have with certainly over the last few months, as we've seen with Melbourne and Sydney, and Adelaide just continuing those plus 80% results. And there's the story with Canberra, as I just discussed. certainly picking up over May and into June quite strongly. And I think that's on the back of, the positivity that's coming out of the Sydney market. So that's it. Our auction results, of course, are available every Saturday night, and we're getting them out a little earlier now, Lou. In fact, you can get your auction clearance rates on a Saturday night at the LinkedIn channel, Doc Andrew Wilson, at around about 6:15. How's that?
No.
So we're true to our mantra of real time insights, and we're getting them out as quickly as we can, even on the day. So. Yeah, all things being well, it depends on, as the results come in, we can get that out now by 6:15. Can you believe it? And Sundays we come out with the national report, which shows in depth what's happening, particularly in Sydney and Melbourne, with Sydney and Melbourne regional breakdown. So watch out for that one. Again, it's an important asset for those interested in property because it gives you a sense of what's happening, as we've clearly shown in the market now, right? And we want to know what's happening now, don't we? So next week, Lou, are you looking forward to next week?
I certainly am. I'm excited what's happening.
Yes, well, we all should be excited if we're in the property market. I think the excitement's not there if you've sat on your hands and waited because, you might have missed out a little bit. But certainly next week we're going to have a look at what is the horror story. Are you ready? The horror story of the May rental market report.
I can imagine.
Australia's rental markets, and I'll just give you a tip, mate. It's not getting any better, right?
No.
For May. So we're going to have a look at that, which is interesting. We'll also look at home building costs, which have started to improve, but we'll have a look at how that's going on if we can get the data out, on a capital city by capital city basis. But there has been an improvement in home building costs, but they're still too high, Lou. And they still offer a roadblock to builders trying to convert those approvals into commencements. And we need as many commencements as we can get, Lou, because we've run out of property just as our rental market is showing us. Now, we've also got the GDP numbers coming out for the March quarter. And, of course, that will show us what's happening with economic growth, Lou. Now, it is backward-looking, March quarter. Hello, we're in June, but nonetheless, it'll certainly be a discussion point. From all those that have been predicting recessions, as a result of higher rates, that GDP data will give us an insight to how our economy is performing, even though it is very much backward looking. Now, we're going to have issues, I think, that if we do get a weaker GDP number, we will have people or commentators suggesting that we're going to head into a recession. Well, we've got to have unemployment, to have a real recession, not a measurement recession. We've got to have unemployment, a lot higher than where it is. And we've got to have wages not rising by anywhere near the rate they are rising, which comes as you get higher unemployment, of course. So that's an interesting discussion. We'll have a look at that. And, of course, as usual, we will have the latest weekend auction results. Can Sydney maintain the rage, Lou? Can it maintain the rage? Can Melbourne match Sydney? Will Melbourne get over 80%?
A real game of state of origin there coming up.
Yeah, well, that's right. And but we've got to remember it's a long weekend next weekend, Lou.
The King's birthday.
The King's birthday, whoever's birthday it is, it's a holiday, right?
Yes.
So it will interrupt because obviously people are, agents sideline the holiday weekends and they wait for the following weekend. So we'll see nonetheless. It's always interesting. There's always some little if or but or maybe when we're speaking about the market, but lots of things to discuss next weekend after, again, another very, very busy week in property, Lou. Have you enjoyed it?
I've extremely enjoyed it. And so in summary, there's chances the rates will go up again. There's chances the rents will continue to grow. There's chances that we'll have less approvals in housing.
Yes.
Boy. And we're going to look for that 85% clearance rate, and we're happy.
Now you're getting greedy, Lou.
We've got to put it out there, haven't we?
Well, we've got to put it out there. But the other thing we can be sure of, that house prices are going to continue to rise.
I think that's a fair prediction.
Fair prediction. We'll see. Good on you, mate.
Thank you.
Thank you, Lou. Catch you next week.
Appreciate it. Yes, sir.